What you want to try to do is minimize those losses and be opportunistic when there's good opportunity and be defensive when there's storm clouds on the horizon.
Understanding risk. It's the number one thing we do. And it should be what everybody is taught to do. But FOMO is a powerful emotion.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today, my special guest, Garrett Waters. He is the CEO of Anchor Capital, and we are going to be discussing risk management in your portfolio and why it is so critical to keep you on track to achieve your long-term goals. Please enjoy my conversation with Garrett Waters, CEO of Anchor Capital. All right, Garrett Waters, CEO of Anchor Capital. Welcome to the Guided Retirement Show. It's great to have you here.
Thank you very much for having me on the show. I appreciate it, Dean.
So, Garrett, we're going to talk today specifically about managing risk in a portfolio. We're not going to go into the detail of the construction of funds or anything like that, but we're going to talk about the concept of managing risk and why it's critical to a person's long-term success and why so many people fail miserably at trying to manage risk. But before we get into all that, why don't you just give us a little bit of background on Garrett Waters and Anchor Capital and your role as CEO and kind of how you see and how your career has evolved, Garrett?
Oh, that's a long one, but I'll go into it as briefly as I can. I started out way back when at JP Morgan Investment Management on the money management side of one of the largest money managers in the country. I worked there for about 5 years out of school, rose through the ranks at JP Morgan, and then was recruited away to go work at a place called Barclays Global Investors, which is now known as BlackRock. So that's out in San Francisco. I'm born and raised in Southern California, so it got me back out on the West Coast. I learned more of the active management side on the JP Morgan, on the individual stock picking and learning about risk management on positions, and then really took it to another level at Barclays, which is now BlackRock. We'll just call it BlackRock, and help them launch all their ETFs, which people know as their iShares. So implementing those strategies for the largest pensions, endowments, and institutions at both JP Morgan and at BlackRock gave me the foundation that what most advisors and individuals are missing is the education on how risk management can play a massive role into their asset allocation and how they can use modern portfolio theory and incorporate risk management and get much better outcomes over time.
All right, so let's tackle that modern portfolio theory statement in the beginning. And the modern portfolio theory basically says that at any given level of risk, there is an optimum level of return that can be achieved through proper asset allocation. That, in a nutshell, is modern portfolio theory. What's the problem with that, Garrett?
The problem is what you saw 2022. Is that when you actually need the diversification of stocks and bonds the most, it tends to fail you. So as we saw in 2022, both stocks and bonds suffered significant losses. And those significant losses have obviously shook a lot of investors and advisors from their financial plans. So by incorporating the risk management, which is what you need, a negatively correlated asset in times of stress that's negatively correlated to stocks and bonds, you actually increase your diversification and lower your risk. And that's why it's so important to add it into your asset allocation.
And when we talk about risk, I think that if we think in the mindset of the individual investor, risk can mean different things to different people. And some people, risk is simply volatility. For some people, risk is the risk of really truly losing something and it never recovering. And so when you're talking about risk management in this, you're really talking about let's reduce the volatility so that it can remove the emotion from the individual investor so that they can stay the course and long term they can achieve similar long-term results, but with far less volatility. Is that what you're saying, Garrett?
What we're trying to get at is we start at the risk first. So many investors start and they look at returns first, and they fall in love with return streams while not really understanding the risk they have to take to get those return streams. So we feel like we have to quantify how much risk is in a security or in a portfolio before we get started. So we look at those risks that we're taking or anyone's taking and basically put a buy-sell discipline around that. So we have a good quantified edge of when risk is present and when it's not present, and then investing accordingly. Obviously, we want to be, when risk is low, we want to be fully invested. And then when risk is high, we want to obviously reduce the risk of the portfolio. And that's where many people get, I'd say, burned in their portfolios or get dissatisfied, is because they don't understand the risk. And then what happens is they think the storm is blowing through, they start investing again, and by not knowing what the actual risks are, they get hurt again. Or they wind up doing the classic investment behavior, buying at the top, selling at the bottom. And that's why if you can quantify those moments, it helps remove the emotion of when you should be in or out of the market. It helps keep people in the market because they know they have something in their portfolio that's going to offset those modern portfolio risks that we talked about before.
Yeah. And so, Garrett, I love that approach of risk first as opposed to return first. And I think that, you mentioned 2022 earlier, and we had some really nice bull market runs throughout 2022, even though the year finished on a horrible level. And we roll into 2023, we get some good returns, and then those returns are getting taken away again. And so it's this whole idea, I think, of people have this fear of missing out, right? Well, if the markets are going up and I'm not fully invested and I'm missing out, what's going on? What's going to happen? No, it's time to go all back in. But a lot of times in these long-term secular bear markets, the bear market traps or those short bull market runs within that secular bear can really hurt people. And so if you've got something in place that can mitigate that risk, that'll allow that person to take place. So what are you doing, Garrett? How do you think about risk in that perspective? And how do you make your decisions whether you should be more defensive or whether you should be more aggressive?
Well, it's a great question. It's very complicated. I'll try to make it very kind of easy to understand. And the way we look at it is we quantify it. So we look back over long periods of time and we quantify when risks are elevated and when risks are not. We also try to stay away from too much exposure. So we manage our exposure in our portfolios, meaning we don't over concentrate or try to put all of our eggs in one basket. So understanding the risk that what you're trying to buy, when those risks are elevated, quantifying when those risks are elevated, and when those risks are low, that's what truly smooths out the returns in the portfolios and prevents people from getting into that FOMO mentality where they're chasing returns. Instead, they know because they have a quantified edge of when they should be putting capital to work or when they should not be putting capital to work. And with our strategies, we have the ability to keep that capital at work at all times because we can play offense and defense.
I think 2020 and the COVID crash, if we can call it that, was a good telltale sign of good risk management. And I look at one of the portfolios that you all manage, and I can give you some of the statistics. I know you know these far better than me, but one of the portfolios, when the market crashed there in March of 2020 due to COVID, I think you had a portfolio that was down about 3% at the time when the broad market itself was down over 30%. And you go to the end of the year and both the S&P 500 and your risk managed equity strategy were both up about 18% for the full year. So an investor in that risk managed strategy didn't experience the gut wrenching drawdown of 30% in the market and allowed them to just sit back and say, I got this. And so they probably experienced it. Other people who had that big drawdown might have said, oh my God, the world's coming to an end. I got to sell everything. And then when do they get back in? And that's what you're talking about, is looking at risk first.
Absolutely. And that is, as you just mentioned, one of the biggest problems that you see with anybody who's trying to do investing. It's a battle between fear and greed. And it's those emotions and managing those emotions. And the problem that you find is exactly what you just said. You could have the highest probability, but fear is high. And people will run to cash, then they'll sit in cash because they have no knowledge of when they should resume investing. And so what happens is they might miss 5 or 10, sometimes 15%, but that could also then be the top. So then they start saying, oh, I missed out. And then they start to put their money back to work, and then it goes right back down again. And then you get into this where people quit investing because in their minds, they can't stick with the risk or the volatility. And again, by understanding those risks and being able to explain it to people, it's a comfort factor, right? I know how much risk I should be assuming or what I am assuming in my portfolio. And I know if I get the risk right, I'm going to get the return right. And so it's looking at investing as kind of the pros do it. People fall in love with return streams. They look at these big high flyers. I'll give you a great example. Cryptocurrency was one of the absolute, when you start hearing about it in the elevator, up and down at work, and how much money, somebody who is making off crypto in a day starts complaining about their stocks and bonds, it's starting to tell you that the risk this person is taking is probably too high. And we saw that it absolutely was. People didn't understand the risks of the crypto currency. They fell in love with the returns. They fell in love with the FOMO. They chased it all the way up. And now it crashed. And not only did it crash, but the opposite of what happens, and this happened in '08, they freeze you. You can't get out. And so you're in an asset that then becomes illiquid. And now you have a different problem. You're trying to get out and you can't get out. So now you have to really suffer the whole brunt of the fall. So it's really understanding the risks of what you're buying. It was probably the number one question we got asked was, oh, what about crypto? What about crypto? And there's absolutely unlimited risk, as you saw, but the return for risk, you would expect to be compensated. There was a moment, but not understanding when to get in and out, obviously, is not for your average investor.
I think I'm glad you bring that up because, crypto was really the new tech bubble, right? The crypto bubble was the 1999 tech bubble. And if you look at the technology stocks in the late 90s that were giving, strong double-digit returns every single year for almost 5 years in a row. And then the dot-com bubble burst early 2000, and it's all taken away. The most interesting thing about that, and I don't know that a lot of people really realize this, I'm sure you do, Garrett, but in the tech bubble, over 75% of all the money that was invested in technology stocks came in the last quarter of 1999. So nobody experienced, most of the people, they never experienced any of the gains in those technology stocks, but FOMO finally took over. And so they jumped in, and subsequently 3 years later, 75% of the value of the NASDAQ had disappeared.
Yeah, it's a great fact, and you're seeing that with, I agree with you, the correlations are very high between a crypto and a .com. And what you saw is the exact same phenomenon, though. What's behind the curtain and understanding the risk. And when you peeled back the curtain of a .com, there were no earnings. There was basically a website and some people trying to maybe sell you something on the website, but they had no revenue or earnings. So very similar to a crypto. Bitcoin, and I'm not saying that with Bitcoin, I'm just saying as a coin, as an example, there's nothing behind it except a buyer and a seller. So you want to be understanding of what the risks are that you're assuming when you get into things, and that those assets can move very, very quickly. And so it's, you're seeing all this race because people who lost their money are now, again, trying to regain it. And that's what we try to avoid, is people going through that zigzag of constantly in a state of recovering back to even. So we try to keep people always growing their assets. It's the reason why people invest is compound return. So people love the compound return aspect on the way up, hate it because they have to give it all the way back. We try to minimize any type of give back so that your money is constantly in a positive state of growth. That's our goal.
Yeah, and obviously it doesn't mean that you're going to be able to manage risk in such a way where there's never a drawdown or where there's never any losses. What you want to try to do is minimize those losses and be opportunistic when there's good opportunity and be defensive when there's storm clouds on the horizon.
Understanding risk. It's the number one thing we do. And it should be what everybody is taught to do. But FOMO is a powerful emotion. We talked about investor emotions in the beginning. It's very hard when you go to the cocktail party and you hear your neighbor talking about his account being up 75%, and then you think, oh, I should be up 75%, but not knowing how much risk that person is taking to get that return. That's why the power of the financial plan is so important and why we fit into asset allocations so well. It's to basically say you can take more risk in the portfolio when you add risk managed strategies. It allows you to basically follow your MPT portfolio because the risk can be high, as we saw with stocks and bonds. But when you add the risk management as kind of a third stool to your asset allocation, it really frees you up to, like you said, relax, stay focused on your plan, stay focused on meeting your financial goals and keeping people on target.
So let's go to this, Garrett. A lot of people want to try to manage risk through asset allocation. And I've done enough analysis of what you all do there at Anchor Capital to have a really good understanding of what you're doing. And when you measure the volatility or the drawdown of your risk managed equity models, you're going to have a drawdown factor that's going to look a lot more like a 60% equity, 40% fixed income, or maybe even less than that. Maybe even it's like a 50-50 or 40% equity, 60% fixed income. But when you start to compare the returns over a long period of time to your models versus that 40, 60, 50, 50 or 60, 40, there's no comparison. So I want people to understand what you just said. When you have that risk management component to your portfolio, it gives you permission to be a little bit more aggressive with other portions of your portfolio so that you can enhance your long-term performance.
You got it. And the idea is that's why we complement existing asset allocations. We don't believe that one strategy fits all, one investment fits all. So we broaden out our risk management into three different kind of categories. And within that, we try to help people offset other risks that they have and also add that kind of further diversification. Again, it's trying to be positively correlated to markets when they're rising and add that negative or neutral correlation when markets are falling. So again, understanding the risks, avoiding the big drawdowns, and hopefully keeping the assets growing or compounding as much as possible, because playing catch up from a very large drawdown can take sometimes years. People have been lucky over the course of time recently that we've had quantitative easing pumping in, which has really been forceful in driving the markets up. But now we're on the opposite side of the coin, and it's becoming a much more challenging environment for investors to navigate, and that's what we're here to help with.
So I'm glad you brought that up, Garrett, because I think that's an important point. When you look at what drove the markets, and really I'll say from the depths of the great financial recession, back in 2008, from the depths of that recession all the way up until COVID and even beyond COVID, what drove the markets was easy monetary policy. It was as if you could say, hey, if the markets start going bad or if the economy looks like it's going to get shaky, guess what? It's the Federal Reserve to the rescue. And they're going to come in and they're going to buy assets and they're going to pump the system full of money. And so I think there was this mindset that the Federal Reserve just removed all the risk from the market. They were going to keep it away. And now we have this ugly inflationary period that the Federal Reserve now knows is far more dangerous than any recession could be. And they've got a mandate now that is to bring inflation back down to their core inflation rate of 2%. And in doing that, potentially leading us into a recession, but they don't even care. And so now all of a sudden the backstop of the Federal Reserve is gone. That's why I think there's more risk out there today than what we've experienced over the last decade.
Of course, yeah. Absolutely agree with you. And by the very nature of, you had a Federal Reserve that was going to backstop downside. So you had the wind at your back and the policy started in '08. They started the experiment. We're in the great financial crisis. Sounding familiar, we're having a liquidity crisis. Banks were freezing, if people remember that. Every Friday, you'd see the news of how many banks were shut down. And then, eventually what they had to do is liquefy the system. And so they pumped it full of free, basically money, very, very low cost money, liquefied the system, and look what you got. You got an incredible run in the markets, very low volatility markets. And then as soon as the Fed announced that, no, we got to start turning the spigot off, which is the big time they really talked about it here was November of last year. You can look at the markets almost just consistently drip down from November all the way to the end of December of 2022. So they started 2021 November, and you went all the way down to December. It's still on now. People's eye is on the ball for interest rates and inflation, whereas our eye on the ball at Anchor is really on the quantitative tightening, which is the opposite of that liquidity and that kind of low-cost money that the Fed was providing. So now they're tightening up conditions instead of loosening them up. So you're getting less liquidity in the system, which means risks are getting elevated. And that's a hard concept for a lot to understand. Everyone's looking for inflation to go down, which is a good thing. But then what you're also seeing is the level of risk is going up at the same time that those kind of numbers are coming down. So it's a challenging environment. It's going to be a little bit more difficult. I think people are going to react in a way that is not normal, because what's happening is the experiment of quantitative easing is being turned off. How does it end? It's never ended before. So now we're going to see if we can make it end and see if we can stick the landing. So it's a very complicated situation.
Yeah, and I also think that you're right. The great financial experiment of the quantitative easing, we still don't know how that's going to end. Nope. We could be dealing with this mess for decades to unwind the issues that the quantitative easing and all of the loose monetary policy have caused. And so that's where I think it's really important. And that's why I love what you guys do there at Anchor in the risk managed strategies, to be able to have a client be able to stay on course and know that there's a portion of their portfolio that's there to help mitigate that volatility and yet not kill long-term results. And I think that's the thing. You look at a lot of the what I'll call long-short strategies that are out there, or the market neutral strategies that are out there. And while the volatility may not be much, the returns aren't much either. So it's like, well, what's the point? I might as well sit my money in cash if that's what I'm really going to do. So you've got a unique track record of being able to mitigate that risk without destroying the returns.
Yeah, and that's why we do it across the three big asset classes that we find in investor portfolios. We find, domestic equity, global equity, and domestic fixed income. Because as you can see from last year, there's risks in all of that, and there's not one solution. So you need to understand where the risks are elevated and where they're low across those big asset allocation decisions you're making in your portfolio. And the more you add to the risk management, at least with our Anchor's risk management, the better your risk-adjusted returns become, and then the better your outcome becomes. And so it really keeps people on target, keeps you on plan, most importantly. So you're not deviating and reacting. Oh my gosh, so I was trying to get a 5% return a year, and now I'm down 25, 30%. I'm never going to get back. It eliminates that emotion. It eliminates that problem by understanding the risk. That's a big job on our part, but that's what we do.
Well, I think you guys are doing an incredible job of it. And I would encourage anybody that's listening to us here on your favorite podcast app or anybody that's watching us on YouTube to reach out through a link in the show notes and schedule a call with one of our certified financial planners to talk about how we can incorporate that risk management into your overall financial plan. But Garrett, at the end of the day, everything begins with the financial plan and really understanding what a person's trying to do. And then the objective that I've always had for my entire 35-year career is to understand what a person wants their future to look like, to create the plan to do that, and then figure out the investment strategy that allows a person to do that with the least amount of risk possible, knowing that risk is always present.
And that's the key. And that helps people achieve their goals. And it's what happens is, this is what happens. 2022 markets happen, and they always are going to happen. And there's no guarantee that they don't happen in back-to-back years, unfortunately. So people think, the reaction you're seeing now is people are thinking, oh, the risk is over. The storm is blown through. Time to reload and really start to take risk. Well, that's one side of the equation. But again, it's understanding what's underneath there of the risks you're taking, because you can step right back into a big negative year. So this is why risk management exists. It gives you that third kind of alternative to stocks and bonds. It gives you greater diversification, less correlation, and it just helps you get a better risk-adjusted return, which is what you just described.
Well, Garrett, thank you so much for taking time to join us here on the Guided Retirement Show. Hopefully everyone has had their eyes opened to really understanding that there are effective ways to manage risk. You can't eliminate it. You can't eliminate volatility in anything unless you're just in a bank account, but then you have the risk of inflation outpacing your performance. So there's no such thing as the perfect investment, but there is such thing as a perfect plan and the perfect asset allocation for every individual investor. And I really appreciate you taking time to share your thoughts on risk management with us here on the Guided Retirement Show.
Thank you, Dean. It was a pleasure to be with you.
Thank you so much for joining me on the Guided Retirement Show, my conversation with Garrett Waters. Hopefully you found that intriguing, and we hope that you will subscribe to the Guided Retirement Show. Make sure and share this with your friends. If you're watching us on YouTube, hit the bell icon, leave any comments that you want, and obviously share it with your friends as well.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.